So imagine you're ordering this like totally top-of-the-line, obnoxiously expensive TV online.
Oh, nice.
Right. And a few days later, the delivery driver drops it off on your porch. You excitedly open the box, and the screen is just completely shattered.
Oh, no.
1,000 pieces.
Yeah.
But in that moment of panic, you don't immediately start yelling at the delivery driver for making a broken TV right.
Right. I mean, the driver just handled the logistics.
Exactly. They just moved a box from point A to point B.
Mm.
The merchant you actually bought it from, the one on the invoice, they're the ones standing behind the product.
Yeah, they have to issue the refund.
Right. So welcome to today's deep dive, everyone. Because while we intuitively get that whole TV analogy, step into the world of insurance, and suddenly we just, abandon all that logic.
It all just goes out the window.
It totally does. We're pulling notes from the Insurance Study Companion today. And our mission for this deep dive is to demystify one of the most foundational, yet honestly most misunderstood concepts in the whole industry.
The insurance carrier.
Yes. Because whether you're, cramming for your CPCU exams, or you work as an insurance professional, or you're just trying to figure out your own auto policy, people constantly throw around terms like agent, broker, carrier.
As if they're interchangeable. Like they're all just synonyms for the same thing.
Right. And they're definitely not.
No, blurring those lines completely obscures how the entire industry actually functions.
So true.
I mean, understanding who actually holds the financial risk, it changes how you view the whole ecosystem. It dictates how you read a policy or how you file a claim.
Right. It's huge. So let's establish a baseline from our sources. What actually is a carrier?
So an insurance carrier, which, by the way, is often used interchangeably with insurer or insurance company.
Okay, got it.
It's the legal entity that assumes the risk, issues the policies, collects the premiums, and pays out the covered claims.
Okay, so the carrier is the legal entity making that legally binding promise to indemnify you, the policyholder.
Exactly. They are backing the contract.
But to really grasp what that means, I feel like we need to separate it from the other faces of the industry that you interact with every day.
Yeah, the text actually gives us this golden rule to commit to memory. It's so good.
Oh, yeah, the memory rule. What is it?
Agent sells, broker shops, carrier pays.
The agent sells. Broker shops. Carrier pays. I like that.
It perfectly highlights that massive operational divide. If we go back to your e-commerce analogy,
Yeah.
the agent is the delivery driver or like the digital storefront. They facilitate the transaction, explain the features, they make the sale.
Okay, but wait. I want to challenge this storefront analogy for a second.
Sure, go for it.
If my agent is just the delivery driver, then why is it that when a claim gets denied, the policyholder directs all their anger at the agent?
Oh, they definitely do.
Right, the agent is the one getting the angry phone call. So isn't the agent at least partially on the hook for the financial risk?
Honestly, absolutely zero.
Wait, really? Zero?
Zero financial risk for the covered event. None. I mean, agents, brokers, even entities like third-party administrators or claims adjusters, they assume zero financial risk.
Wow, okay. So why all the yelling at the agent?
Well, you direct your anger at the agent because they're the human face of the transaction. You know, they explained the coverage, shook your hand, sent the holiday card.
Oh, right, the person you actually know.
Exactly. But legally speaking, the agent is not backing the contract. When an agent sells a policy, they're selling the carrier's promise, not their own.
So they might have to deliver the bad news that your loss isn't covered, but they aren't the ones who kept your premium money in their own bank account.
Right. Now, there is a critical nuance here for anyone working in the industry.
Okay, what's that?
While the agent holds no financial risk for the event itself, they do have a professional responsibility.
Like if they mess up.
Yeah. If the agent misrepresents the policy, say they tell a client they have flood coverage when they totally don't, the agent could be sued for errors and omissions. E&O.
Ah, gotcha.
But that's a separate professional liability issue. The actual risk of the house flooding, the mathematical probability of that loss, that sits entirely with the carrier.
Okay, that makes sense.
Yeah.
And the study companion has a really specific memory trick for this, right?
Yes.
Huh?
Carrier equals carry the risk.
Carrier equals carry the risk. That is sticky. It really forces you to visualize this entity carrying the weight of all that financial exposure on its shoulders.
It really does.
But thinking about the sheer volume of that exposure leads to a massive logistical question for me.
Okay, lay it on me.
If the carrier is carrying the risk for thousands or millions of policyholders, how do they not just go bankrupt?
It's a fair question.
Like if I personally promised to pay for everyone's car crashes in my city, my bank account hit zero, by Tuesday afternoon.
Tuesday morning, probably.
Right. So how do they survive it?
Well, surviving that exposure requires a massive operational engine. Insurers don't just blindly accept risks and hope for the best.
I would hope not.
Right. They employ this rigorous gateway before a policy is ever even issued. It's called underwriting and pricing.
So underwriting is basically the bouncer at the door of the risk pool.
I love that. Yes, the bouncer, the analyst, and the mathematician all rolled into one.
Okay, break that down for me.
So underwriting is the process where the carrier evaluates an application and decides, first, if they even want to accept the risk. They can just say no.
Just flat out, no, too risky.
Exactly. But if they do accept it, the underwriter figures out how much coverage they're willing to offer and what the premium needs to be to actually make it sustainable.
Right, the cost to you, the policyholder.
Yeah. And they don't just pull those premium numbers out of thin air.
Right, the sources detail how they use this complex mix of loss experience, risk classification, and actuarial analysis.
Which is a fancy way of saying.
A fancy way of saying they look at massive amounts of historical data. Exactly.
Okay.
Like, how often do similar drivers crash? How often do buildings made of this specific wood catch fire?
Yeah, they use these mathematical models to calculate the probability of future losses. That way they know exactly how much premium they need today to pay for tomorrow's accidents.
So the actuaries build the math models, and the underwriters apply those models to the individual people applying.
You got it. They categorize you based on risk factors to make sure you're paying a fair rate relative to your likelihood of having a loss.
But if they mess that up, like
Yeah.
if the underwriters accept too many high-risk policies without charging enough, the carrier's financial foundation just cracks.
It starts to crumble quickly. Yeah.
Okay, but all that beautiful actuarial math means nothing until reality hits.
All right, the moment of truth.
A tree falls on a roof. This is where the promise is actually tested.
And that brings us to the claims function. This is where the abstract financial promise becomes tangible,
The check gets cut.
basically. When a loss happens, the carrier starts an investigation. They have to see if the event actually falls under the terms of the contract.
So was the tree falling caused by a covered windstorm or just like long-term rot that was excluded?
Exactly. And if it's covered, the carrier is the entity that actually cuts the check to make the policyholder whole.
Now, I want to clarify something here because this trips a lot of people up.
Oh, the TPA thing.
Yes, the person who comes out to look at the tree on your roof, the claims adjuster, they're the ones communicating with you.
Yeah, they're the face you see.
Right, but sometimes they work for an entirely different company, right? A third-party administrator or a TPA.
Oh, yeah, TPAs are super common, especially in big commercial insurance programs. A carrier might just outsource all the logistical headaches.
Like answering phones and inspecting damage.
Right, they pay the TPA a fee to do all that paperwork.
But the TPA is just processing the paperwork. They're another logistical arm, just like the agent.
Exactly.
The money flowing out to pay for that new roof is draining directly from the carrier's bank account, not the TPA's.
The risk remains firmly with the carrier. Always.
Okay, but wait. Let's say I'm an insurer in Florida.
Okay, risky business.
Very. And my actuaries are absolute geniuses. They've priced every individual home perfectly based on its roof age and distance from the coast.
Right, perfect math.
But then a Category 5 hurricane hits Miami, and everyone cashes in their promise on the exact same day.
Oh, yeah.
Math for individual homes doesn't stop bankruptcy when an entire zip code is leveled.
What?
So how does a carrier survive that level of concentrated, catastrophic risk?
Well, no carrier can withstand infinite concentrated loss. It requires a really sophisticated risk management toolkit.
What's in the toolkit?
So they don't just sit statically on the risk. They actively manipulate their exposure. And diversification is their first defense.
Oh, like not putting all your eggs in one basket.
Exactly. A smart carrier won't just insure houses in one coastal town. They'll insure houses across the entire country. And they'll probably insure cars and businesses, too.
Right, so a massive storm in Florida is devastating.
Yeah.
But the premiums you collected from, like, perfectly safe homes in Ohio help absorb that shock.
Exactly. Ohio and Nevada auto policies balance out the Florida hurricane.
That makes perfect sense. But even with diversification, a big enough disaster could theoretically overwhelm a single company, right?
Definitely. Which is why the study companion highlights a mechanism called reinsurance.
Reinsurance. It sounds a lot like insurance for the insurance companies.
Because that's basically what it is. It's the most critical tool in their risk management arsenal.
How's it work?
Well, think of it less like passing a baton and more like a relief valve on a massive pressure
A
cooker.
pressure cooker, okay.
So the primary carrier absorbs the initial heat, the primary risk, but they set a threshold, let's say it's $50 million.
Yep.
If a hurricane hits, they pay claims from their own reserves. But once those losses cross that $50 million mark, the pressure gets too high.
That's when the relief valve opens.
Exactly. The valve opens and a reinsurer steps in to take the excess pressure.
Mm.
They reimburse the primary carrier for the losses over that threshold.
Wow, okay. But the primary carrier had to pay a premium to the reinsurer for this protection.
Right. Of course. It's a calculated transfer of risk. It just ensures the primary carrier doesn't just explode under the weight of one catastrophic event.
So they're constantly monitoring their exposure and basically buying their own safety nets.
Exactly.
But, I mean, we can't just trust massive financial institutions to police themselves and hope their math is right.
Oh, definitely not.
Right. Because if a carrier gets greedy, writes too many policies to collect premiums, and doesn't buy enough reinsurance, the policyholders are left holding worthless contracts.
Which brings in the heavy hand of regulation.
Ah, here we go.
Yeah, carriers operate in a highly scrutinized environment. They have to answer to regulatory bodies, primarily the State Department of Insurance in every state they operate in.
And the regulators aren't just looking at consumer complaints, right?
Yeah,
They're looking deeply at the carrier's financial solvency.
exactly. And the notes specifically call out a metric regulators use called risk-based capital, or RBC.
RBC. Now, this isn't just about having a certain flat amount of money in a vault somewhere, is it?
No, it's way more sophisticated than that. RBC is like a dynamic shock absorber. Regulators use it to ensure a carrier has enough liquid capital relative to the specific amount and type of risk they've taken on.
Oh, so it shifts based on what the carrier's doing.
Yeah. Like, if a carrier decides to invest its premium income into highly volatile stocks instead of stable government bonds, the regulators will force them to hold more liquid capital in reserve.
And if they write a ton of risky commercial liability policies,
Then the RBC requirement goes up. It fluctuates based entirely on their behavior.
it's a customized safety margin. That is so smart.
Yeah, and if a carrier's RBC ratio drops too low, it triggers automatic regulatory intervention.
Like the state steps in.
The state will step in, demand a corrective action plan, or in extreme cases, just take over the company to protect the policyholders before the money completely runs out.
Because if the carrier goes under, the promise they made just evaporates.
Yep. You could have the most knowledgeable, supportive agent in the world, but if the carrier backing your policy doesn't have the capital, you are totally exposed.
Right. Okay, let's ground all of these abstract mechanisms, the underwriting, the reinsurance, the RBC, in a real-world scenario.
Sounds good.
The sources provide this great narrative example. We have a business owner named Lee.
Okay.
Lee needs commercial property insurance for his company's massive distribution warehouse.
A pretty standard, everyday transaction in the commercial world.
Right. So Lee calls up his local independent insurance agent. The agent does their job. They shop around, compare options from different carriers, explain the coverages, and Lee buys a policy.
Okay, perfect.
Fast forward a few months. A devastating electrical fire completely destroys the warehouse.
Devastating.
Millions of dollars in damages. When the smoke clears, who is actually responsible for funding the reconstruction of that warehouse?
Based on the fundamental mechanics we've been talking about, the financial responsibility falls entirely on the insurance carrier.
Not the independent agent who shopped the policy?
Nope.
Not the broker who might have assisted? Not the bank holding the mortgage?
Definitely not.
And not the online courting platform Lie used to find the agent?
The carrier is the sole legal insurer in the contract. The agent facilitated it, the underwriter priced it, the claims adjuster will investigate the ashes, but the carrier's capital is on the line to indemnify Lie.
It's so clear when you walk through it like that, and this exact dynamic keeping these roles perfectly compartmentalized, it is a massive sticking point for anyone tackling their CPCU exams.
Oh, huge. The text explicitly points out that this concept is the foundation for almost all the advanced coursework.
Like which ones?
You literally cannot progress without internalizing this. The study companion highlights CPCU 500, which is Managing Evolving Risks, CPCU 520 on insurance operations, 530 covering business law, and 540, which dives into finance and accounting.
Wow, so pretty much all of them.
Yeah, every single one hinges on knowing where the liability sits. You can't understand insurance operations or finance if you think the agent is paying the claims.
That makes total sense. And the notes even generously give away a classic exam trick question.
Oh, I love this part.
The test will present a scenario and ask which party actually assumes the insurance risk.
And the multiple choice list is always a minefield.
Always. You'll see options designed to confuse you based on your everyday interactions, like the insurance agent, the insurance broker, a third-party administrator, and the insurance carrier.
And beginners fall for the traps because they rely on personal experience instead of legal definitions.
Exactly. They hear their local agent say, "Don't worry, I've got you covered," so they just confidently check the box for agent.
Or they remember a TPA handled all the emails during their last fender bender, so they assume the TPA holds the risk.
Right. But the table in our sources provides this brutal, undeniable visual. Does the agent assume risk? No. Broker? No. Claims adjuster? No. TPA? No.
The only entity on that entire list with a green check mark next to assumes risk is the insurance carrier.
Only the carrier carries the risk. Keeping this straight goes way beyond passing a multiple choice test, though.
Oh, absolutely.
To me, it's about fundamentally understanding the nature of the contracts we sign and the products we buy. When you purchase insurance, you aren't buying a tangible object like that television.
You're buying a piece of paper that contains a financial promise.
Yes. And if you don't know who is actually making that promise, you don't truly know what you've bought.
That knowledge empowers you as a consumer and honestly as a professional.
Totally. Like if you're comparing two auto insurance quotes and the premiums are drastically different, you shouldn't just be looking at the bottom line price or how friendly the agent is.
You need to look at the financial strength, the reputation, and the solvency of the carriers backing those quotes.
Because if that cheaper quote is from a carrier with terrible claims service, or their risk-based capital is teetering on the edge of regulatory intervention.
Yeah, that seemingly affordable premium might end up costing you everything when a disaster actually strikes and their bank account is empty.
And for insurance professionals, internalizing this distinction is what allows you to properly advise your clients.
You have to know how the gears turn behind the curtain. You might be managing the client relationship, but you have to understand that the carrier's underwriting guidelines, their pricing models, and their strict capital management. That's what dictates what you can even offer the client in the first place.
It really is a beautifully complex ecosystem when you zoom out.
It is.
The agent sells, the broker shops, the carrier pays. Let's pull all these threads together and recap our mission for today. We set out to demystify the core definition and operational mechanics of an insurance carrier, and I think we built a pretty solid foundation here.
I agree. Just to synthesize the key takeaways from our sources, the carrier is the legal entity that assumes the financial risk.
Right.
They use complex underwriting and actuarial analysis to price that risk appropriately. They manage the claims process when covered accidents occur, and they fiercely protect their own financial survival through diversification, capital management, and reinsurance.
And their ability to keep their promises is heavily monitored by state regulators using dynamic metrics like RBC. So whether you are up late cramming for your CPCU 520 exam, or you're just sitting at your kitchen table trying to figure out which auto policy to buy for your teenager, keeping that golden rule in the front of your mind changes your entire perspective.
The agent sells the policy, but the carrier stands behind the promise.
Knowing exactly who is financially responsible makes you a sharper professional and a far more protected consumer. You aren't just buying a policy, you are entering into a long-term financial relationship with a specific entity whose survival dictates your safety.
A relationship built entirely on the mathematical probability of risk and the capital required to carry it.
Well said. But as we wrap up, there is one piece of this puzzle, one specific mechanism we discussed that I just can't stop thinking about.
Oh, which one?
We talked about how primary carriers manage their massive catastrophic risks by using reinsurance.
Right, the pressure relief valve.
Yeah. They use that valve to transfer some of that risk off their own books and onto a reinsurer to stay financially solvent.
It's the ultimate safety net for the insurance companies themselves.
Right, but that creates a fascinating paradox.
How so?
If the primary carrier is passing the buck to a reinsurer to protect themselves from a localized disaster, who insures the reinsurers?
Oh, wow.
Right? If a truly global catastrophe hits a massive systemic event that impacts multiple continents simultaneously, and the reinsurers are suddenly on the hook for billions upon billions of dollars from hundreds of different primary carriers, how far up does this chain of carrying the risk actually go before the buck finally stops?
That is a very good question.
Where is the ultimate bottom of that financial well? Something for you to ponder until next time. Thanks for joining us on this deep dive. See you next time.